Hello guys, today welcome to another video lecture in ACC 311 Income Taxation. I hope guys that you are all doing well as we progress with our subject ACC 311. We are now leading into an end of the term. But before we end of our term, let us discuss the remaining topics for our subject. This time we will be discussing regarding gains and losses from dealings in property. Okay? When we talk about dealings in property, it again includes disposal of property. May it be ordinary asset or a capital asset. So we will be discussing in this specific video lecture the treatment or the tax consequences when a particular taxpayer derives gain or incurs loss from disposal of property. Okay? Let's start it by defining what is a capital asset. So the term capital assets means property held by the taxpayer whether or not connected with his trade or business. So when we talk about capital assets, guys, these are assets or these are properties of the taxpayer which are apart from the properties related in the business. Or in short, capital assets are those assets which are not related to business. Okay? Example of these capital assets are um, house and lot, that is for residence, real properties, that is not related to trade, or any other personal properties that is not related to trade or business. So that is what we call capital asset. On the other hand, ordinary asset follows the residual definition, meaning if it is not a capital asset, then therefore it will be considered as an ordinary assets. So ordinary assets are any assets owned by a taxpayer that is related to trade or business. Example of such are number one, stock in trade, property of a kind which would be included in inventory of the taxpayer of if on hand at the close of the taxable year, or in short all types of inventories, no, are considered as ordinary assets. Letter C, property held by the taxpayer primarily for sale to customers in the ordinary course or of trade or business. So example, when the taxpayer is actually a real estate agent, so obviously the house and lot that is being sold by that real estate agent is considered as an ordinary asset. Although in form, it may be a house and lot for residential, but again, since it is in substance considered as an inventory on the point of view of the seller, then therefore it will be considered as an ordinary asset. Letter D, personal property used in the trade or business which is subject to allowance for depreciation. Example are those machineries and other equipment which are again used in the conduct of trade or business. And lastly, all real property used in business. So examples are the building and the land where the building is built is considered as an ordinary asset. Now, we need to properly distinguish, guys, an asset whether it is a capital or an ordinary one because later on, the gains and losses derived from disposal of these types of assets differ. Okay? So, we really need to distinguish whether it's a capital asset or an ordinary asset. Okay? Continuing our discussion, we have here guidelines from RR7 of 2003. Those engaged in real estate business, only transfer of ordinary assets to another person can convert the nature of property from ordinary to capital asset. So involuntary transfers like expropriation or foreclosure do not affect the classification of such property. So it is still considered as a sale or exchange of ordinary assets. So just like what I have mentioned with you earlier, guys, that when the one who is selling a property is a real estate business, so therefore any real property that is the subject of that sale will be considered as an ordinary asset on the point of view of the seller. Okay, that's the only time when there is a sale, no, the classification of that property becomes a capital asset when the buyer of that property is actually intending that property as a residential property and not to use it as part or as or in relation to their business. So as long as it is not yet sold to any other parties, when that house and lot or parcel of land or building is not yet sold, then on the point of view of the real estate agent, then that will be considered as an ordinary asset still. Now, however, if the ones who is selling that property is not engaged in real estate business, nature of property may be changed from ordinary to capital assets provided that they show proof that the same has not been used in business for more than 2 years. So that means, guys, there is still a chance for you to reclassify your ordinary asset to a capital asset one. Okay? The only requisite or the requisite that is to be considered before you are able to classify an asset from ordinary to capital asset is that you should not use that property or such property should have not been used in business for more than 2 years before the the taxpayer could reclassify such property from ordinary one to a capital asset. Okay? Also, those real property used in exempt transactions are also considered or will be considered as capital assets for exempt corporations. Now, we have here the different terms associated in capital assets. You have number one, net capital gain, net capital loss, and lastly, your holding period. When we talk about net capital gain, it is actually the excess of capital gain over your capital loss. So obviously, capital loss, capital gain, guys, it happens when you dispose your capital asset on a gain. Okay? Obviously, there is a gain when the selling price is higher than the cost of the property. So there is net capital gains when there are more capital gain generated over the capital loss incurred by a particular taxpayer. On the other hand, your capital loss capital loss is capital loss is the opposite of your capital gain. There is capital loss, net capital loss, when your total loss, okay, is exceeding your total gain. So obviously, your capital loss also is generated when your total cost, no, the cost of the property that is being disposed is higher than the selling price of that property. Okay, so when we talk about capital gain or capital loss, what is being disposed is a capital asset. Again, capital asset are those assets which are not related or has not been used in the business. Lastly, guys, we have here holding period. Your holding period, it's the length of time the asset was held by the taxpayer. So it covers the period from the date of acquisition to the date of sale. Now, let us move with the important points that we need to consider when we are actually dealing with disposal of properties. So, letter A, short-term capital asset or short-term capital gain or loss or capital asset has been held for not more than 12 months. Okay? So that means if the property, guys, is with is short term, the property is short term, meaning the property has been used or in the ownership of the taxpayer for not more than 12 months, then that means your your capital gain or capital loss will be considered 100%. Okay? It will be accounted 100% kapag ang taxpayer is other than corporation. Okay? Example, um, your individual taxpayers. So when an individual taxpayer is actually disposing a property and then the holding period is short term, so any gain or loss derived from that disposal, guys, will be accounted 100%. However, if it is long term, the holding period is long term, so that means the capital asset has been held for more than 12 months, then that means only 50% can be accounted if the taxpayer again is other than the corporation. Pero take note, when the corporation or when the taxpayer is a corporation, holding period is not considered. There is no consideration of holding period when the taxpayer is actually a corporation, because regardless if it's short term or long term na consideration or long term na holding period, it's always 100% ang i-account ni corporation. No? Regardless if it's a gain or loss, or capital gain or capital loss, 100% of it will be considered in the computation of your taxable income. And then we have here letter C, limitation on deduction of capital losses. Now here's the case, guys. When there is a capital loss, okay, when there is a net capital loss, so obviously there is a net capital loss when your total capital gain is higher than, or there is a capital loss when there is higher capital loss over your capital gain. Okay? So that, ano guys, um, that capital loss of yours, okay, can only be deducted, or capital losses shall be allowed only to the extent of the capital gains. Okay? So that means any excess of your capital loss sa inyong capital gain cannot be or will not be allowed to be deducted sa inyong ordinary gains. Okay? So that means, for example, if you have capital loss of 10,000 and you have your capital gain of only 5,000, so the only amount that you are allowed to deduct is only up to the amount of your capital gain. So that means the amount that you could claim as a deduction lang is only up to the 5,000 nga capital gain. Okay? So that's actually the same rule sa corporation and sa individual or other types of taxpayer. Capital losses shall only be allowed only up to the extent of the capital gains. But here's the case, guys, on letter D. Net capital loss carryover. Whatever is the amount of the excess, okay, of your net capital loss over your capital gain can be carried forward to the next year. Okay? So, any amount nga wala nimo na deduct as part of your capital loss because of the limit, kay ang imuha lang mang allowed ma-deduct is only up to the extent of your capital gain, pwede nimo siya ma-carry over to the next year. Okay? Net capital loss is carried over to the succeeding year as a short-term loss. So that means 100%. Pero the amount to be carried over is only the lower between the net capital loss and the net income in the year the loss was sustained. Okay? So, dili gihapon absolute na 100% ang imuhang ma-claim as deduction as your capital loss next year, because you will still consider the net income of the year which such loss was incurred. Okay? So later on, guys, we will have sample illustration para for you to have better understanding of this rule sa net capital loss carryover, or other term it as nakolko. Okay? Nakolko, it is a net capital loss carryover. Pero that nakolko is only applicable to, or is only applicable to taxpayers other than the corporation. Okay? It is only applicable to taxpayers except corporations. Kasi nga, si corporation walang kakolko. Okay? Walang nakolko, walang capital loss carry over. So that means if there is a capital loss that is not deducted, so that means that will be watered, no? That could no longer be deducted in the future years to come. Okay. So I think that should be clear. The important notes na kinahanglan nato timan-an here sa dealings with properties. So number one, again, when the property is a capital asset, so you need to look at with the holding period first kapag ang taxpayer is other than the corporation. If it's short term, ang long term short term ang holding period, then that means 100% capital gain or capital loss will be accounted. Pero kung long term ang holding period niya, only 50% will be accounted. Pero kapag corporation, regardless if it's short term or long term, lahat ng capital gain or capital loss will be accounted. And then the rule on your capital loss. Again, your capital loss can only be deducted up to the extent of your capital gain. Pero if your taxpayer is other than corporation, you could carry it over for the next year. As long as, again, it is lower than the net income, it is lower than the net income in the year the loss was sustained. Okay? So let us proceed with your illustrations. So let's have here Sophia, an individual taxpayer, had the following income and losses for calendar year 2018 and 2019. So it has for 2018 ordinary taxable income of 30,000 and then short-term capital gain of 12,000, short-term capital loss of 27,000, and for 2019 ordinary taxable gain of 36,000 and then long-term capital gain of 48,000. Now, I'd like to make it clear here, guys, when a taxpayer disposes an ordinary asset, okay? When a taxpayer disposes an ordinary asset, so any gain or loss will really be included to its taxable income. When there is an ordinary gain, it will be added to the taxable income on its full. Pero pag naay ordinary loss will also be, or when there is loss on disposal of that ordinary asset, that will also be deducted sa iyahang ordinary taxable income because that is an ordinary asset. So in short, any disposal or any gain or loss derived from disposal of an ordinary asset will be forming part of your ordinary taxable income or your taxable income itself. So, ang ato lang ginahisgutan diri clearly is the treatment on how are we going to account when there is a disposal of capital assets. Okay? So again, the rules when there is a disposal of a capital asset was already mentioned in the previous slide. Okay? So in this case, you have the for 2018 ordinary taxable income of 30,000 and then we have short-term capital gain of 12 and long-term capital loss of 27,000. Take note that the taxpayer here is an individual taxpayer. Okay? The taxpayer is an individual. So therefore, holding period will be applied. Holding period, that is 50% for long term, 100% for short term. Okay? So, short term capital gain will be accounted in full, pero itong short term or long term capital loss will be only accounted for 50%. So, to continue our illustration, we have here for 2018, you have 30,000 na ordinary taxable income. So, yun nga guys, yung sinabi ko kanina, na whatever gain or loss derive from disposal of an ordinary asset, that's already included here sa inyong ordinary taxable income. Okay? So, what if there is disposal of capital asset or there are capital asset transactions? So, there is a disposal of a short-term capital asset that generates gain. So, since this is short-term, so it will be accounted in full or at 100%. So, 12,000 less short-term capital loss because we are allowed to deduct capital loss up to the extent of your capital gain. But in this case, guys, okay, that's okay. I think there is an error in this illustration, guys. So this 27,000, it should be short-term pala ha. This is short-term. it should not be long term. So dapat short term siya para 100% gihapon ang iyahang holding period. So again, short term. So assumption nato sa capital loss is also short term. So that is why it will be accounted on its full or its entirety na 100%. So 12,000 minus 27,000. So therefore, you have a net capital loss of 15,000. Okay? Net capital loss of 15,000. So again, rule na to, your capital loss can only be deducted up to the extent of your capital gain. So here, natay net capital loss na 15,000. So since this 15,000 is the excess of your capital gain, it cannot be deducted to your ordinary taxable income of 30,000. Again, it cannot be deducted to your 30,000 because it already exceeds your capital gain of 12,000. But again, what's good is that this 15,000 can be can be carried forward next year and can be deducted as capital loss carryover. So therefore, in 2018, guys, the taxable income of Sophia will be 30,000. Okay? The taxable of Sophia will be 30,000. So it seems that her disposal of capital asset has no effect since, again nga, meron man siyang net capital loss. So that net capital loss can be carried forward for the next year, 2019. Okay? So note that the net capital loss is not deductible when it already exceeds your net capital gain. Now, let us proceed to 2019. Considering that on 2019, it has an ordinary taxable income of 36,000 and a long-term capital gain of 48,000. So since it is long-term capital gain, so therefore only 50% of it can be accounted. So 48,000 times 50%, so we have 24,000 nga nga capital gain for the year 2019. And now take note that we have 15,000 loss na net capital loss last year that is allowed to be deducted this year. So take note, we will or we can deduct the full 15,000 because the amount that we will be deducting as net capital loss carryover is the actual net capital loss or the net income on the year such loss was incurred, whichever is lower. So ang net income sa year 2018 is 30,000 and ang capital loss niya kay 15. So therefore, mas gamay man si loss ng 15,000. So we could deduct the full 15,000 in the year 2019. Okay? So therefore, 24,000 na gain minus 15,000 nga capital loss carryover. So there we have a net capital gain of 9,000. And that net capital gain will be deduct or will be added to your ordinary taxable income of 36,000. Okay? So that makes the taxable income of Sophia becomes 45,000. Okay? That becomes the taxable income of Sophia, 45,000. Now, assume that ordinary taxable income of Sophia in 2018 is only 12,000. Okay? So, assuming that the ordinary taxable income is only 12,000. Okay? 12,000 lang daw. So, again, the taxable income of Sophia for 2018 will still be 12,000 because again nga the total loss was 27 and the gain is only 12. So the net capital loss of 15,000 cannot be deducted to your ordinary gain for the year 2018 but can be carried forward for 2019. Pero guys, sa 2019, you cannot deduct 15,000 in full kasi nga the taxable income of Sophia for year 2018 is only 12. So remember the rule, the basis of the capital loss carryover that can be deducted next year is the lower of the net income of the year the loss was sustained or the loss or the actual net capital loss. So in this case, mas gamay man si 12,000. So that means the only amount that can be deducted to the capital gain of Sophia is 12,000. So 24 minus 12. So there is a net capital gain of 12,000. So that makes the taxable income of Sophia for 2019 becomes 45,000. Okay, so 36,000 plus the 12,000. So in 2019, the taxable income of Sophia will be 45,000. Now, let us proceed. What if the corporation this time is the taxpayer this time is a corporation? So again, as a rule, holding period will not be followed. There is no rule on holding period when the taxpayer is a corporation. So regardless if it's a short term or long term na capital asset and it was sold for a gain or loss, any gain or loss will be accounted on its entirety or on its full or at 100%. And another rule that we need to remember on dealing with capital assets for corporation, no kakolko or no nakolko can be carried forward. No? No? Walay capital loss carry over nga mahitabo if ever your total loss is higher than your total capital gain. So example, a domestic corporation has the following data on its operations for the current year. So it has capital gains from the sale of capital assets held 10 months and 14 months. So in short, this 45 is short term and this 14 months is long term. So kung individual pa ni guys, then i-multiply na to ni si 10 months by 100% and then si 14 months by 50%. But again, the taxpayer is a corporation man. So therefore, this holding period will be of no use, no, in considering the amount that can be considered. Now let us assume that in the preceding year it had a net capital loss of 15,000. Okay, meron daw siyang net capital loss last year. So the computation of the net taxable income for the current year will be as follows. So in this case, the ordinary net income will be 300,000. So coming from the illustration, so assuming that the ordinary net income is 300,000, so add capital gains. So how much is your capital gains? So we have 45 plus 75, so we have a total of 120. And again, regardless if it's a combination of short term or long term, it will really be accounted at 100%. So you have a capital gain of 120, and then you have a capital loss of how much? 30 plus 60. So the entire 90,000 will be deducted to your um, capital gain of 120,000. So that means there is a net capital gain of 30,000. And also take note, we did not deduct the 15,000 capital loss from last year because nga of the rule that we are not allowed to carry over any net capital loss incurred by the corporation in the previous year. So that means that 15,000 is already watered. It could no longer be used as a deduction to compute for the taxable income of the corporation this time. So in this case, so the taxable income will be 120 plus 90. There is an additional 30,000 na taxable income to the ordinary net income of the corporation, giving you or giving that domestic corporation a total taxable income of 330,000. Okay? So there's a taxable income of 330,000 for that corporation also. Okay, this time guys, I'd like you to remind that we also have dealings of properties which are subject to final tax. So again, you should remember this that when the properties which are disposed are number one, sale of shares or shares of stock not traded in the local stock exchange, and real property classified as capital asset like land and building, that will not be subject to ordinary tax. Okay, dili siya subject to ordinary tax. So example, sale of shares of stock not traded to local stock exchange, it will be subjected to 15%, no, capital gains tax based on their net capital gains. It is not 5 and 10% but 15% on the train law as amended by train law. So again, we have discussed already this one and this one. So again, remember when the taxpayer disposed land in building and it is classified as a and it is classified as an ordinary asset, capital asset, when a taxpayer sold a land and building and it is classified as a capital asset, then therefore it will be subjected to capital gains tax of 6% based on selling price or fair market value, whichever is higher. Okay, now let's proceed. So, additional important notes on the valuation of our property or cost basis for determining gain or loss from sale or disposition of property. So we have already discussed it in our one of our video lectures, but again, let for review, let us um have it once more. So when the property was acquired through purchase, so ang cost basis na to guys will be actual cost. So again, all of these cost basis will be compared to the selling price in order for you to determine the gain or loss from that disposition of property. So when the mode of acquisition of the property was through purchase, then therefore to compute for the capital gain or loss, it will be compared, selling price will be compared to actual cost. Pero if it is acquired through inheritance, so the cost basis will be the fair market value on the time it was inherited. Okay? The fair market value on the time it was inherited. And then if it's by gift, so same as it would be at the hands of the donor or last preceding owner, except if cost basis is greater than fair market value, and then cost basis shall be the fair market value, so whichever is lower. Okay? Cost basis or fair market value, whichever is lower, will be the basis. And then, acquired for less than adequate consideration, okay? Acquired for less than adequate consideration, guys, it is when um the selling price is lower than the fair market value. Okay, the property are acquired, no? The selling price of the or the acquisition cost of the property is lower than the fair market value. So that is the time where there is acquisition for less than adequate consideration. So the amount or the cost basis will be the amount paid by the transferee. Okay? The amount paid or the amount paid by the transfer, in short. And last two, acquisition cost is increased if acquisition cost is increased by the improvements materially added. Okay, if acquisition cost is increased by the improvements materially added, so any acquisition, any improvements added to that property will be adjusted to either 1, 2, 3, or 4. Okay? So, cost basis plus the amount of the improvement or the increase of the improvement will simply be added para makompute na to ang total cost. And lastly, guys, if it's acquired under a previous tax-free exchange. Okay? So, cost basis will be your substituted basis. Okay? Sige. Additional notes, tax-free exchanges. That means no gain or loss shall be realized in a sale or exchange of property pursuant to a plan of merger or consolidation. Number one, where a corporation exchanges property solely for stock in another corporation, which is also a party to the merger or consolidation. Letter B, where a shareholder exchanges stock in a corporation for the stock of another corporation, which is also a party in the merger or consolidation. And then letter C, where a security holder of a corporation exchanges his securities solely for stocks or securities in another corporation, which is also a party to the merger or consolidation. And lastly, where property is transferred to a corporation by a person in exchange for stocks in the corporation. And the result of such exchange is that the person alone or together with not more than four person gains control of the corporation. When these circumstances happen, then there is no gain or loss shall be realized from that exchange or sale of property pursuant to plan of merger or consolidation. So again, you just simply familiarize all of these provisions in order for such disposition of property becomes tax free. Okay? So we have here sample exercise. Guys, this is for you to answer. You have ABC Corporation having the following data for years 2019 and 2020. So our taxpayer here is ABC Corporation. So it has gross income for 2019 of this much, and then business expenses of 180. So again, guys, your ordinary taxable income is the difference between 250 and then 180. And it will be adjusted if ever there is a capital gain that is to be added. Okay, for 2019. Same for 2020. So this time you are tasked to compute for the tax payable. Okay, how much is the tax? Okay, not tax payable, but how much is the taxable net income in 2019 and 2020 respectively. So assuming that the taxpayer is a corporation. However, when the taxpayer is an individual, considering it is a single resident citizen, compute also the taxable net income in 2019 and 2020. So again, if you got the correct answer, please comment down it below. Okay? Your answers, comment down below your answers for exercise, whether you have really gotten our um, lecture or discussion for this video. Okay? So I think that's it for our video lecture. So I am looking forward for your answers to check whether you're correct or not. Okay? So again, thank you very much for participating in this video lecture. So I hope that you have got something with this lecture, and if you have any more questions, please do comment also your questions or prepare it during our virtual class, or you could simply connect with me. Okay? So that's it for today. Thank you and God bless.